Okay, hey everyone, Lance Morgan here, and I am so glad you're watching this video because hands down, without question, this is the most important thing that I could ever teach anyone about money, and that is the power of uninterrupted compound interest. Now, I'm sure you've heard about the power of compound interest, but the problem is that we never actually let it compound because we keep interrupting it. We save for college and then we spend it on college. We save for retirement and then we spend our money in retirement. We never truly allow our money to compound. So in today's training, I want to talk about the power of uninterrupted compound interest. Now, my mentor, when I went through this training and learned all about money and different financial strategies, my mentor used to give me the analogy of going to play in the Masters golf tournament. So if you're a golfer, then you'll get this analogy. If you're not a golfer, then just go with me on this. But let's say you're going to go play in the Masters golf tournament, and you probably need a little bit of help if you're not at that level, okay? So luckily, I can give you one of two things. Either the golf clubs of anybody who's ever played a round of golf. So take your pick of any clubs out there, the best clubs on the market, or their ability. Which would you rather have? Now, clearly, this club, now this isn't a horrible club, but it's probably definitely not the best club on the market, and I'm definitely not the best golfer on the market. So, if you were to play in a golf tournament, the club isn't as important as your ability. And when it comes to money, we always compare different financial vehicles like we do golf clubs, when in the reality of it is that we really need to understand the strategy. We need to understand the technique. It's the swing that is far more important than the club. So with that in mind, I'm going to show you 3 different clubs, all right? 3 different vehicles, but I'm going to teach you a technique that will make the difference seem huge, okay? Because it is huge. Uninterrupted compound interest is the big difference, and that is the technique that I'm going to show you. So first of all, let's take a look at a 401k. Now, you may have, if you work for a nonprofit organization, you may have a 403b or a 457, or maybe you have an IRA, but they're all in the same family. Maybe you even have a Roth IRA, or maybe you're just saving money into mutual funds. It doesn't really matter. The point is that if you have a traditional retirement vehicle that is money in the market, let's just say anything that has money in the market, then you're going to go off of what we call the 4% rule. Now, some people would say it's more like the 3% rule. Some people might say the 5% rule, but let's go with the 4% rule. If you read here on Google, you can Google it, say the 4% rule, and it says the 4% rule states that you should withdraw 4% of your portfolio each year in retirement for a comfortable life. Now, here's the theory. The theory is that you're probably going to shift all of your money into something more conservative. So you're probably going to go into like a bond portfolio, for example, okay? So that bond portfolio might earn, 5% on average if you're not going to, because you don't want to risk losing all your money while you're in retirement. A lot of people learned that the hard way in our recession of 2007 and 8, when from top to bottom, the S&P went down about 56%. And it took a lot of years for those people to get their retirement back to where they could actually retire. So most people and most financial advisors are going to counsel you to put your money into something more conservative going into retirement. So let's say that you earn about 5%, okay? So if you're earning an average of 5% in your 401k during retirement, there was an article on Forbes. If you go to Forbes, there's this real cost of owning a mutual fund. So it talks about the fees. Now, I'm not going to go through this whole article, but there's what they call the expense ratio, the transaction costs, going down, scrolling down, all the way down to tax costs, cash drag, soft dollar cost, advisory fees, so on and so forth. And we get down here to the bottom where it says the real cost of owning a mutual fund is now 3.17% in a non-taxable account. So that's going to be like your IRAs, right? Or your 401ks, or a 4.17% in like a taxable brokerage account. Okay. So in this particular case, you're going to run out of money. If you're paying 3% in fees and you're earning 5%, that's not going to bode well with you. So maybe you read a book like Tony Robbins wrote on fees and how high fees are. So maybe you shift everything into an S&P 500 Vanguard fund or something like that, and you get your fees down really low. Okay, so the idea would be is that if you get your fees to around 1%, you're going to live on 4%. Okay, that's the 4% rule. All right, so your income, if we take $1 million, and let's put $1 million in all of these. Okay, 1 mil. If we have $1 million in our 401k, that means that we get an income in retirement of $40,000. Okay, that's your 4%. So now it's probably the most depressing thing you've heard all day, but that means that you get to retire on $40,000 a year if you have $1 million in a 401k. Now keep in mind, you've got a partner. Okay, the government owns a portion of that. If it's not like a Roth IRA, the government owns a portion of that money. So part of that $40,000 is going to go to the government. You're going to have to pay your taxes because you didn't really save any taxes. You just deferred the taxes. Okay, now you've deferred them. You've kicked the can down the road. Now it's time to pull the money out and you get to retire on $40,000 a year. Right now, you also have some fees in there, but the theory is if you live on the interest, that's the whole idea of this 4% rule. The theory is that you're going to build your money up to where you hit that million, and then the theory is you're going to live on the interest, okay, which is going to prevent that uninterrupted compound interest. So your money is no longer going to continue to compound from $1 million to $2 million to $3 million during retirement. The theory, according to the 4% rule, is to live on the interest. Okay, now let's contrast that with real estate. And let's say that we have $1 million in real estate. Now for this example, I'm going to show you what I call the 401 condo. All right, let's just put 401 condo. Now, the 401 condo really doesn't exist, but it's to compare a 401k with real estate. So I have this little side by side. Let's walk through this. Let's say that we're talking about $2,000 payments. We've got 6.5% return. So let's say that this is assuming that our real estate is going to increase by 6.5% a year. So it's not the same as compounding interest. Real estate just appreciates in value. So let's say that it's going to appreciate at 6.5% a year. Let's say that you're in an ordinary tax bracket of 30% and a capital gains tax bracket of 15%. Let's look at 30 years. So those are our assumptions. Okay, so in this example, we have the 401k on the left and we have the 401 condo or the real estate over on the right. Now, let's talk about taxes. The first thing we talk about is income reduction. So you don't really save money on taxes by putting money into a 401k. You are literally just reducing your income for that year, but you are deferring the taxes until later. With a 401 condo, or in other words, real estate, you really actually have a tax deduction. Any sort of tax deduction that you acquire that year because of the real estate is an actual deduction off of your taxes. Big difference in taxation between a 401k and real estate is you've got income reduction versus tax deduction, okay? Now, the 401k, you do not pay capital gains every year. There's no tax bill every single year. It's what we call tax deferred. You're not paying taxes. Therefore, the money that's not going towards taxes is compounding. That is better than if you had your money in a taxable account where you're paying taxes every year. The 401 condo, however, or the real estate is also tax deferred. Okay, so your money in the real estate, okay, if you own a rental property, your value, just the value, not the income coming from the real estate, but the value of the real estate, if the real estate goes up in value, you do not have to pay capital gains every single year. Okay, now the internal rate of return, if we're talking about 6.5% on the 401k, would be about 4.71 after the taxes. That would be your internal rate of return. So after taxes, you're looking at about 4.71. Now with the 401 condo, it's actually a little bit better because of the capital gains. Okay, so because of capital gains being different than ordinary income tax, there's a little bit of difference in your capital gains taxation, okay? Now, when you sell your 401k, in other words, when you start to retire, this money coming out of your 401k is taxable at an ordinary income rate. Now, I know the theory is that you're going to be broke when you retire, and so you're going to be at a lower tax bracket. But do you think that taxes are going to go up or down? Most people think that taxes are going to go up. I mean, let's face it, we're in trillions of dollars in debt. So if taxes go up, then you're actually going to be at a higher tax bracket. But let's just say that you stay at the same tax bracket. You're still going to be taxed on this money that you pull out as ordinary income. In fact, let's just say that you have $300,000 left in the year of your death, and you've been living on $30,000 a year. Well, in the year of your death, all $300,000 is counted as ordinary income in that year, putting you in one of the highest tax brackets. So even if you're not considered wealthy and you only have a little bit of money, everything in a 401k or an IRA is all going to be passed, right? Or is all going to be taxed in the year of your death. Then it goes to your kids, and they have to pay income tax on what they receive. So the amount that actually gets passed down from generation to generation is not very much, okay? Now, in a real estate example, when you sell the real estate, okay, you have a capital gains tax, okay? So if the value of your real estate goes from $100,000 to $200,000 when you sell it, if you sold it while you were alive, okay, then you would pay $100,000 of capital gains tax. Generally, right now anyway, for a lot of people, capital gains rates are lower than ordinary income tax, right? Now, how about when you die, okay? Like I was just saying a minute ago, when you die, all of your money that's left in the 401k is 100% taxable at ordinary income. So meaning all of the money left in your 401k counts as income in the year of your death, okay? So even if you only have $300,000 in a 401k, you probably wouldn't consider yourself rich, especially based on the 4% rule. 4% of $300,000 isn't very much, but in the year of your death, all $300,000 gets added to your income. Now, here's the benefit of the 401 condo. When you die, it's what we call a step up in basis. Now, what that means is that if you purchased a house for $100,000, a rental property, let's say, an investment property, and that grew to $500,000, okay? If you sold it while you were alive, you would have a $400,000 capital gain. However, if you pass it to your heirs, or if you hand this over to the next generation and they inherit it, they get a new basis, meaning that if they sold it for $500,000, okay, when you passed away, there would be no capital gain. Now, let's say that they sold it 1 year later and it had gone from $500,000 to $550,000. Well, then there would be a $50,000 capital gain, not back to here. They get a step up in basis, meaning that it's based on what the value of the property was when you passed away and handed it to the next generation. Huge. Way better to leave assets to the next generation here than over here. Huge difference, okay? Now, the 401k has participation limits. Now, that's depending on, some things, but basically there's a limit, and you can do SEP IRAs, and there's a lot of different, I'm not going to get into what those limits are, but there's a limit as to what you can put into the 401k, and then there's a limit of $1 million loan, for the real estate. So you kind of have a couple of limits there, but, there is, only, certain limitations, and that depends on a number of things as well. You make contributions into your 401k. So every month you're putting contributions into your 401k. And in a 401 condo, you're not just contributing to it every month. You could refer it to some friends. If you wanted to refer it out and do some trades or something like that, or use it for business opportunities. There's just different ways to get creative with using your 401k on a month-to-month basis. Instead of just making contributions to an account, you're actually utilizing this piece of real estate. When you have a 401k, you get statements, all right? You can take that statement, your 401k statement, and put it up on your fridge if it's something you're really proud of. But with a 401 condo or with real estate, you have pictures. Maybe you spend some time here at the beach, with your family. So there's pictures that you could have. All right. Now, no enjoyment during the working years. I don't know very many people that have a lot of enjoyment from their 401k. It's more stress than anything. But with a real estate, you have a lifetime of memories. Now, this is not even rental income. This isn't even assuming a rental income. This is like assuming that you own a condo on the beach somewhere or in the mountains where you can go and have fun as a family. It's still an investment for you, even if you don't get any real rental income from it. You're locked out of your 401k until you're 59 and a half, which basically means that you don't have access to the money without some steep penalties, right? Whereas with the 401 condo, you can enjoy it the whole time you are alive. You don't have to wait for any particular time to enjoy your 401 condo. There are penalties if you access the 401k prematurely, but with the 401 condo, there are plenty of opportunities. You can use it as leverage if you wanted to borrow against. You could, trade somebody else so that you don't have to collect money, because if you collect money, you pay income tax on it. But maybe you trade a weekend in your condo with a weekend in somebody else's condo, and then you don't have to pay for it. So there's some trading opportunities are there. The 401 condo, or the 401k, you have to access the money when you're 70 and a half, or you get penalized. The government wants their taxes, so they force you to start pulling the money out. Whereas with the 401 condo, you could leave it to your family. And they could, you don't have to ever pull it out, okay? You could enjoy it the whole time you're alive, and then it could stay in the family. Now, this is comparing the golf clubs, the 401k golf club versus the 401 condo golf club. However, that's not what's important. What's important is the swing, okay? Well, like I said in the very beginning, uninterrupted compound interest is the single most important thing that we're talking about here. Now, it just so happens that I was renting a house while we were building this house, and I got to talking with our landlord one day, and he happened to have a few different properties totaling $1 million. So I said, hey, isn't that ironic? This goes along great with my analogy that I teach on. I said, do you mind if I ask how much income you collect every year from that $1 million worth of real estate? And he said, yes, about $63,000. Okay, so $63,000 a year versus $40,000. Now, you've already got an increase right there in income. If you had $1 million in real estate versus $1 million in your 401k, you've already got a significant increase in income. Okay, now, does he have fees? Yes, he has property taxes, he has insurance costs, he has some upkeep, okay? But if it's true that mutual funds have a 3% fee on $1 million, that would be $30,000 a year. I know for a fact that he doesn't have $30,000 a year in upkeep, property taxes, and maintenance, right? Or upkeep, property taxes, and insurance costs, okay? You don't have to buy a piece of real estate where you live. You could buy a piece of real estate in Utah where I live, where property taxes are less than $1,000 a year, when insurance is less than $500 a year on a small house. You don't have to pay these high expenses. So you could easily, take home, a big portion of that. However, this is also taxed as ordinary income, okay? So this rental income is also taxed just like the $40,000. However, I finished building the house, we moved out, I got to talking to the landlord, and he said, you'll never believe what the management company is now going to charge. We were paying $1,300 a month, and now the management company is going to charge $1,600 a month. So what did he just get? He just got an increase in income during his retirement years. Whereas with the 4% rule, the idea is to live on the interest and hope and pray that you don't dip into the principal and end up running out of money before you die. But with the real estate analogy, if he's getting an increase off of that $63,000, that also is a huge advantage. Okay? Now here's the biggest difference. If he has $1 million worth of real estate now, assuming that the market continues to do what it has done historically over a 20-year window, would that $1 million of real estate be worth more or less when he dies? Keep in mind that if you only lived on the interest over here, the most you would ever leave your family is $1 million. but then the government is going to take probably half of it, and then they're going to get taxed again. So you might only leave about 18%. I've seen some numbers show that it's about 18% that you're going to be leaving your family. Okay? So if that's the case, then over here, what if our $1 million worth of real estate turned into $3 million someday because of the uninterrupted appreciation, in this case, of the real estate? And you get a step up in basis. So you could literally be leaving your family maybe $3 million of assets that they get a step up in basis on, and you get an increased income during retirement. So in comparing these two, does it make you wonder why everyone puts money into a 401k? Or does it make you start to consider, how real estate is a pretty viable option? Now, whenever I teach people about life insurance, the first question everybody asks is, why didn't my financial advisor teach me this? There's got to be something wrong with it, or my financial advisor would have told me about it. Well, let me ask you this. How many wealthy people do you know who own real estate as part of their portfolio or part of their assets, part of their retirement? Okay. How many people do you know own real estate? Probably most of them. I would say most of the wealthy people I know have some real estate. Okay. So how many of your financial advisors have sat down and explained this to you and helped you to compare your IRAs or your 401ks with some real estate options? The reason why financial advisors typically don't teach you about real estate is because they don't make money on real estate. And if they don't sell life insurance, or if they don't understand life insurance, that's probably why they're not teaching you about that either. So now let's talk about what would happen if you had $1 million in cash value in a life insurance policy. Okay, so $1 million life insurance policy, okay, that you have. Now this is where we're going to need to pull up my computer here and look at some numbers. Okay, $16,000 a year starting at age 40. All right, so by the time you're 41, you would have saved $16,000, and you keep saving $16,000 a year until you finally have $1 million right here. Okay, so down here is when the life insurance has $1 million worth of cash value, and it happens to be saving $416,000, right, until age 66. That's $16,000 a year. They finally have $1 million. Just like if we had $1 million in a 401k, or just like if we had $1 million in your real estate, we've got the same thing here. In fact, it just so happens that this right here would be going into a 401k. So let me just back up and show you that, since I have these numbers here. Instead of putting $16,000 into a 401k, you get to put in more into the 401k because it's pre-taxed. But there is a before tax column and there is an after tax column. This is after you've paid your taxes, assuming that the taxes don't go up on you. So assuming taxes don't go up, this is how much you get to take home, which happens to be the same amount, if I scroll over here, happens to be the same amount in the Roth IRA if the taxation stays the same. So what we're looking at here is the life insurance versus a taxable account, brokerage account, an IRA 401k type account, and a Roth IRA account, okay? So if we put the same amount, $16,000 a year, and by the way, if we're earning a 6.5% return on all four of these accounts and paying 1.5% in fees, that's half the fees that the Forbes article said is the average fee. So if we're only paying 1.5% in fees on these three accounts, in the life insurance, the fees are way different. The fees are very heavy up front, which freaks people out, but it's actually a really good thing because you're paying your fees when you don't have as much money, so that later on down the road, who wants to pay $30,000 a year on $1 million 401k when you're supposed to be compounding interest? That's $30,000 that is not compounding interest anymore. It's better to pay high fees in the beginning and not at the end, okay? But that's for a different training. So let's come down here and look at $1 million in the 401k or in the life insurance. Okay, $1 million in the life insurance. You are able, in this particular case, according to the estimates here, you're able to borrow, that's the key. Remember, we want to borrow the insurance company's money at 5% using your money as collateral. All right. So notice what's happening to my account value. My account value is going up. So the amount that I'm earning interest on goes up, which means by the time, if I scroll over here, by the time you're 76 years old, your account has gone from $1 million to $2 million because, okay, you did not interrupt compound interest. That is the most important thing I could possibly teach somebody about money, is the power of uninterrupted compound interest. Okay, so it also allows us to increase our income. Now here's the best part. If you're trying to compare the $70,000 in the life insurance to the $63,000 here, you can't, because there's a huge difference, and that is this is income tax free. That's right, income tax free. Okay, which means that you're literally borrowing $70,000 a year. If that was your only retirement income, you could literally qualify for food stamps. I mean, these are loans. We are borrowing the money. You have no income, okay? There's no income of record, basically, which means that you could maximize your Social Security income because you don't have any income that is, causing your Social Security income to go down. So if you want to maximize Social Security income, this is also a benefit. But what's the most important is that my cash value is doubling in value because I'm still earning 6.5% on average. And I've shown you in my original training how our clients have been averaging more like 7-8%. But even if you averaged 6.5%, okay, and you borrowed the money at 5.5%, so this is what I'm showing you is just a 1% spread. And remember, in my original training, it was all about earning a 1% spread. Okay, so with a 1% spread, if we borrow $70,000 a year, that could increase to the point when you're 76 years old, you could be borrowing $91,000 a year on, just as an estimate here, $91,000 a year, and your account is still growing. Okay, now let's scroll down here and look at the latter part of life here. When you get into your 80s, okay, at 82, you have an estimated $3 million still earning an average of 6.5% interest. Now, yes, we've been borrowing all this money at 5% and we haven't paid any of it back. We don't pay it back until we die, okay? It just comes out of our account when we die. So, by the time we are in our 80s, we're starting to live on $100,000 a year income tax free. That is far more than the 401k, all right? And it's income tax free. Your after tax amount of this is next to nothing, okay? It's small. Okay, so we're earning $100,000 a year in our 80s, and it's still going up because by the time we are 86 years old, we've got $4 million in our account still compounding interest. So we've still got this uninterrupted compound interest. Now, granted, the amount that we are borrowing, okay, the amount that we are borrowing is also compounding interest at 5%, or in this case, 5.5%, so that we're only showing you a 1% spread, okay? So that's why if you were to die at age 95, you would not be leaving your family the $7 million, okay? You're not gonna leave your family $7 million because you've borrowed $3 million at 5% interest, which means that the amount that you owe the insurance company is the difference between the $7 million and the $691,000 that you have left over. Okay? So, if you were to pass away, there's a little bit of life insurance as well. So you would leave your family a total of $762,000. Income tax free. There is an estate tax if you have an estate tax problem. Most people don't. But it is income tax free. So $762,000 will go to your family income tax free. Now that's not as good as the real estate, okay? The real estate would probably leave more money to your family in the form of real estate because the value of that real estate is going up, your income is going up as well. However, the life insurance has a very significant increase of income. If you don't want to increase your income that much, you don't have to. These are just projections. You can take out as much money or borrow as much money as you want. There's no rules. There's no age. There's no amounts that you have to borrow. So if you don't want to borrow $138,000 when you're 90 years old, then don't borrow that much. And the amount that you would leave your family would be higher. So if you want to leave your family more money, when you pass away, if you want to leave a bigger legacy, then don't spend as much in retirement. But if you're more worried about having an increased retirement income, which is my personal opinion, I want to spoil my kids and my grandkids while I'm alive. And so I'm more concerned with spoiling them while I'm alive and helping them while I'm alive instead of when I'm dead. All right. So there's some pros and cons to all three of these. Now, as a disclaimer, I am not making any assumptions. I do not know anything about your financial situation. Past performance doesn't, result in future performance and all those other disclaimers that I'm supposed to say. Okay. But talk to your financial advisor. Ask them what they recommend you withdrawing during retirement. I know my aunt's financial advisor, because it was her brother, he told her 3%. So maybe your advisor will tell you 4, maybe 3, maybe 5, but whatever the case may be, you are interrupting compound interest. That's the problem. And if you're not careful, your account will go down and you could potentially run out of money in retirement, which is the biggest fear of most baby boomers nowadays. Okay. So with real estate, you have an appreciating asset and your income increases. Obviously, a lot more risk in both of these. In the life insurance, it's guaranteed to never lose. The worst you could ever get is 0. And it all grows tax-free, just like a Roth IRA taxation-wise. All right. And you get to access the money income tax-free through the form of loans. And you get to leave all the money to your family income tax-free as well. So now you know how all three of these compare with each other. And now you know the power of uninterrupted compound interest. Now, if you're interested in working with us, there should be a link below that you can get started and we can run some of these numbers for you. I look forward to talking with you soon.